So good afternoon, everyone. My topic for today will be all about pro-forma financial statements. Before we jump into the numbers and the data itself, if you see my head spinning side to side like I'm watching a tennis match, I promise I'm paying attention. I'm just working entirely off two different screens right now. So one with a laptop and one with a tablet. So yeah, I'm just juggling my reporting materials and the presentation view. So please bear with me if I'm looking back and forth. So with that, let's get into the pro forma financial statements. And I hope my screen is already projected right now. So yeah, um, again, pro forma financial statements. Um, the report itself is like we are modeling the future or translating our budget plans and revenue forecasts into expected financial outcomes. And as strategic managers, we don't just look at past data itself to see what happened. We also want to build forward looking architectures to navigate future uncertainty. So, our goal for today is to understand how we can translate our high level strategic visions, budgeting guardrails, and even revenue forecasts into fully articulated or like expected financial outcomes. So, let's look at what these statements or financial statements fundamentally represent and why they form the baseline corporate financial forecasting. So let's get into slide 2. What are pro forma statements? So the definition of pro forma um, originates from Latin. It means as a matter of form. So let's ground ourselves into this terminology. In the real corporate world, pro forma statements are financial projections built on a foundation of explicit logical assumptions or hypothetical scenarios rather than purely historical account of balances. So we're not just looking into what happened last year, we are also looking forward head on what could potentially happen if this are the existing like accounts, the assets of the company and such. So to excel in this strategic planning, an MBA like us must clearly distinguish three core financial documents. So first, we have the historical statements. These are backward looking. They tell you precisely what actually happened in the past. The second one are budgets. So these are operational blueprints. They establish like the line by line spending limits and like cost controls and departmental targets. And the third one is the one that I'll be discussing for today, the pro forma statements. This is where the magic happens, if I can call it. They integrate everything, they bridge the gap from those historical statements and the budgets that the current organization have. So they integrate everything. They show us what the entire financial health of the business will look like if our operational budgets and revenue growth forecasts are fully realized. So it is our financial like crystal ball built on rigid accounting logic. So going forward, what are those three big pro formas? These are the most common pro formas and universally used by most organizations. So these are the pro forma income statement, the projected profitability, pro forma balance sheet, projected assets, liabilities, and equity, and then the last one, the pro forma cash flow statement or the projected cash inflows and outflows or the liquidity of the organization. So, pro forma income statement, this models our projected profitability. It takes our revenue drivers, strips out variable and fixed costs, and show us whether our strategy as a company, as an organization, yields a healthy net surplus or bottom line loss. So we can like look forward as to will this be profitable or not? Something like that. Next one is the pro forma balance sheet. This projects our future capital structure, the assets, liabilities, and equity. Or in the context of cooperatives, member savings and capital, because the members are the ones who are putting their capital in the co-op, right? So it answers the vital question: what will our financial position look like at the end of the execution window? So something like that. And then the last one is the pro forma cash flow statement. This tracks liquidity. A company can be highly profitable on paper, but go completely bankrupt if cash inflows and outflows are misaligned or mismanaged. That's why this statement ensures we have survival on the runway. Okay. The next one: why do we think, or why are pro formas crucial for an MBA perspective, like us students that are studying this? So again, why is this module so vital for our MBA toolkit? Let's look at this three high level corporate pillars. So the strategic scenario planning, the capital and resource allocation, and the regulatory and stakeholder compliance. So um strategic scenario planning, pro formas give us the framework to conduct what if sensitivity analysis. So I'm pretty sure that most of us are very familiar with what if analysis. So for example, if we are managing a logistics division, we can instantly test what happens to our bottom line if diesel prices spike up by another 15%, or by tweaking our assumptions, the entire pro forma model recalculates, exposing our operational vulnerabilities. Let's put it in a layman's term. So, just for example, um, me as an employee, what happens to my take-home pay if the price of the gasoline spikes up by another 100 peso? So technically, there will be a rundown domino effect on my takeaway home pay. So that's like logically a similar situation of this strategic scenario planning. The second one is the capital and resource allocation. So it protects liquidity. Pro formas allow us, or allow corporate treasurers to identify impending cash deficits months in advance. So we can already look forward as to what could potentially happen. And we can determine if the business will need to secure a credit line, do we need to borrow money, or issue equity before a structural cash crunch actually hits. So this will give us the visibility of how the current assets are looking into the health of the financial health of our organization. And the third one is the regulatory and stakeholder compliance. So in institutional settings like cooperatives, um, corporations, or limited companies, expansions cannot proceed on gut feelings alone. We're not doing that. Feelings aside, whether you are presenting to a regulatory board, an aggressive venture capital group, a general assembly, or corporate stakeholders, you must present data-backed pro formas to prove that your future expansion designs are financially viable. It's not just like we are just purely assuming here. Our assumptions here are based on data, historical data, what could potentially happen. This is our projected numbers and such. So let's move on to the common pro forma methodology. So this is the most common method of pro forma. We call it percentage of sales. So let's talk about this methodology. How do we actually build this out? The most widely used framework in corporate finance is the percentage of sales. We call it percentage of sales. The core underlying concept is quite very simple. It assumes that specific variable financial accounts, such as, let's say, cost of goods sold, inventory, accounts receivable, accounts payable, it moves in direct proportion to the organization's top line revenue. So it's simple as that. So the mathematical engine is very straightforward. Here's the formula. Projected account is equal to historical percent of sales times forecasted sales. So the advantages are very clear. It is incredibly efficient to prepare, intuitive to explain to board members. It requires minimal historical data points, and serves as an excellent foundation tool for short-term financial planning and estimating funding gaps. However, as MBAs, we must stay alert to like its limitations. So it operates on a linear assumption. Again, it's purely assuming on a linear assumption that variable accounts increase at the exact same rate as sales. In reality, it completely overlooks fixed overhead constraints, economies of scale, structural capacity limitations, in inflation and such. But furthermore, it also loses reliability if macroeconomic conditions shift or sudden operational disruptions occur. Okay? And yeah, so let's now proceed to how is this percentage of sales method is being executed. So I prepared 5 steps in doing this percentage of sales method. So the first one is to estimate the future sales. Determine the expected sales for the next period. Most likely, companies, organizations, cooperatives already have like a forecast, or they can already provide they can determine the expected growth. But again, it's not just purely an assumption. It's already backed up by so many information and data. So this is just for an example. The current sales for this year is 500,000 pesos, and the expected growth is 20%. So let's just say current sales for the year 2025 is 500,000, and then the company or the organization has already provided an information that the expected growth is 20%. Then our forecasted sales it's 600,000 pesos, meaning 500,000 times 20%. It's 600,000 pesos. Next, the second step is we have to determine or identify which are our varying accounts. So this elements here that you can see, these are just examples. It could have a lot that could be listed there, but for sample purposes, I just only listed those. So let's say we have cost of goods sold, you have selling and administrative expenses, accounts receivable, inventory, accounts payable. So let me just give you an example of or the definition of such. So again, don't limit yourself in thinking that these are the only accounts. It it could be varying, it could be a lot depending on the nature of the business itself. So, what is cost of goods sold or COGS? So, it refers to the direct costs associated with producing or purchasing the products is what the company sells, or maybe the labor itself that is being provided, services. It typically includes like raw materials, direct labor, manufacturing overhead, while excluding it's not yet included the indirect expenses like marketing and rent. So that's what we call the cost of goods sold. And then we also have here selling and administrative expenses. So sometimes we call it SG&A. These are companies' day-to-day operating costs that are not directly tied to production or manufacturing. So this is the inverse of the COGS. These are overhead costs such as marketing, rent, executive salaries. These are vital for business operations, and listed below the gross profit line on the income are like selling expenses, like the cost incurred to store, promote, and deliver goods to customers and such, like sales staff salaries, commissions, advertising, freight expenses, and such. So those are examples of selling and administrative expenses. We also have here accounts receivable. So accounts receivable or AR refers to the outstanding balance of money owed to a business by its customers for goods or services delivered on credit. So it's money that we that for example, I have a business, it's the money that I can get from my customers as I have already rendered the service, I have already provided the goods or the products, but they haven't paid it yet. So I have to receive some of those money. So that's why we call them accounts receivable. We also have inventory, like the physical stocks of our products, and accounts payable are the ones that we have already received. Like I'm the business owner itself. I have received the product. I have been um rendered with the service that I need, but I haven't paid yet to the one that I owed to. So that's what we call accounts payable. So once we have identified these varying accounts, again, don't limit yourself to this five. There are a lot. Then we can already calculate historical percentages. So as you can see on my first example earlier, the current sales are at 500,000, which means that that's the 100% of sales. Then our historical projections, we can uh how do we call this one? We can um express each variable to be accounted as a percentage of sales. So in my example here, since this is the current sales, and now we are looking at the forecasted sales, because when I said earlier 500,000 times 20 of the expected growth, then our forecasted sale is 600,000. So 600,000 here is our forecasted sales. But here, these are our amounts that we have that was incurred during that period. Then we can express these numbers into percentages. So 300 divided by 500 is 60%. 100 divided by 500 is 20%. 75 divided by 500 is 15%, and 125 divided by 500 is 25%. So we have all accounted for the percentages of those accounts, and then we carry it over to our forecast. So as you can see here, this is the 600K that is our forecasted sales. And then we have our projected percentages as mentioned earlier. So just multiply the forecasted sales into the varying percentages that we have identified earlier. So we have 60% of 600,000 is 360. And then 20% of 600,000 is 120 pesos. 600,000 pesos times 15% is 90,000 pesos. And the 25% of 600,000 is 150 pesos. So as you can see, we just accounted it based on the percentages that we have assigned earlier. And the last step in our percentage of sales method is to prepare the pro forma financial statement. This is just a very simple example. Sorry about that. So for example, our forecasted sales is 600,000 less what are those expenses that we have paid for, or what are those that we have bought, what are those that we have paid. So for example, cost of goods sold, is it like we have bought raw materials to make our products? Is it the what else? Um let's say the labor that we have paid to make those products. So that's the cost of goods sold. So 600 minus 360,000 pesos, we have a gross profit of 240,000 pesos. But gross profit does not yet mean that's already our take home pay. We also have to um deduct the operating expenses, the one that I've mentioned earlier, like the selling and administrative expenses, because we have also paid some indirect costs for making our products, our services, and such. So 240,000 pesos less 120,000 pesos is a sample. Our take home net income is 120,000 pesos. I hope that's clear enough with our sample of the Pro-Forma Financial Statements, and what else? So um let me check what else do I need to discuss on this part. So yeah, I think pretty much that's the like the gist or the summary of the like the most basic computation of the percentage of sales. But just to give you like what are those pros and cons of the percentage of sales method. So to summarize this methodology before we look at our live case study, remember that percentage of sales method is highly valued for its simplicity and practicality because it provides immediate actionable baselines for budgeting and identifying like shortfalls as a as the business expands. But as a future business leader, we must never rely blindly on it alone. It operates on the rigid assumption that relationships between accounts remain completely fixed. It ignores step costs like needing to build an entirely new warehouse once sales pass a certain threshold, and completely misses the impact of black swan like economic shocks and so use this like as a powerful baseline, but always supplement it with robust sensitivity testing. So I guess we can proceed with the like the main case study that we have done with one of the companies that our group um the member of our group is currently employed with. So we have actually studied Unified Port Users, Multipurpose Cooperative or UPU Co-op. Let me just go to my um discussion materials here. So more importantly, a quick disclaimer regarding the numbers that you're about to see on my presentation. When we conducted our immersion and went to the co-op, they were legally bound by strict data privacy and confidentiality protocols, meaning they were not allowed to disclose their actual financial statements. And therefore, this pro forma that I will be presenting to you do not reflect their real historical numbers, but instead, we have constructed simulated financial projections that mirror their exact scale and operational structure based on our qualitative findings. So, we've ensured that the key variables and the operational drivers remain highly relevant to the actual case, giving us a realistic framework for the analysis for our discussion. So, with that context in mind, let's look at our baseline assumptions. Uh huh. Where is my um so here let's bridge the theory into actual corporate application. So let's analyze a real world style MBA case. So again, our um organization that we have used in our case study is the UPU Co-op, Unified Port Users Multipurpose Cooperative. They are also Cebu based. So yeah, in our case study, we are projecting a 3-year model from an actual baseline of 2025, 2026, and 2027. So let's unpack our foundational model assumptions. So again, these are all assumptions, but are somehow relevant to the real world scenario of what's happening with UPU co-op. So our macroeconomic and growth drivers for 2026, we forecast a strong 20% revenue growth. This is driven by newly acquired port related service contracts. And for 2027, we are also projecting a 15% growth rate via membership expansion. So as you can see, I've input there also some keynotes. Um, and yeah, so cost of services is at 60% of revenue. Um, and this actually matches the historical operational trends. So let's stick with the 60% COS from the revenue, and the um administrative expenses are relatively fixed but adjusted up by 5% annually to protect against inflationary pressures. So basically every year, um we have assumed that there's really like an increase of 5%. Okay, and crucially, because this is a cooperative, we must strictly factor in statutory fund allocations mandated by the cooperative code. 10% goes to the reserve fund, 5% to the cooperative development fund, 5% to the education and training fund, and the remaining 80% is allocated for dividends and optional reserves. So I also input there our assumptions on the percentages, and um uh the actual ending cash baseline is 700K, and gross revenue sits at 10 million pesos. So, cash beginning of year 2025, this also means that this is the cash ending of year 2024. Okay? So, let's proceed now. Let's trace how these drivers play out on UPU Cooperative's pro forma statement of net surplus. So, in 2025, here, in 2025, actual gross revenues were 10 million, as you can see here. So that's also the reason why it's actually here the 10 million pesos. That's the gross revenues of 2025. And then applying our 20% growth assumption, revenues rise to 12 million in 2026. So that means 10 million times 20% is equal to 12 million. That's the reason why it's 12 million here, because um it's multiplied. So 10 million times 20%. Okay. And then same goes with 2027. So it's 12 million times 20%. No, no. 12 million times 15%, because we have revenue growth rate different for each year. As you can see, in 2026 it's 20%, in 2027 it's 15%. So 10 million times 20%. So 10 million plus 20% of it is 12 million, and then 12 million times 15%, then you add 12 million, it's 13,800. So that's how you got those numbers. And then next one is because of our like cost of port services that scaled exactly at 60% of revenue. So our growth surplus here, our growth surplus scales smoothly at a constant 40% margin, giving us a 4.8 million in 2026 and 5.52 million in 2027. So how did we calculate it? So it's just basically um let me check. So it's just 10 million less 6 million, it's 4 million, and then 12 million less 7.2 is 4.8, 13.8 less 8.28 is 5.52 million. So that's our gross surplus. Then again, applying the percentage of sales method that we discussed earlier, gross profit, gross surplus is not the technically not yet the take home pay, something like that. We have to deduct what are those administrative or and operating expenses. So we also have incurred 2.5. So here, 2.5, 2.5, and then in our um let me check. Administrative expenses is 5%. Okay. So 2.5, and then 2.5 is our administrative and operating expenses, and in our assumption, every year it grows 5%. So 2.5 times 5%, you need to add that 5%. So it's now 2.625, and then this 2.625 plus the 5%, because it's fixed every year, it became 2.756250. And then again, from this gross, we just need to deduct here 4 million less 2.5 is 1.5. 4.8 less 2.625 is 2,175,000 pesos. 5 billion less 2.756250 is 2.70-ish million dollars. I mean pesos. So again, this numbers that you are seeing here, this is the um net income or net revenues. As I've discussed earlier, it's likely the take home pay after deducting everything that the organization or the company has paid to make the operations or the business keep running. And as you can see, the numbers here are the allocations from that take home amount. So I've actually included like legends of colors here. So the red is the reserve fund, the yellow is the cooperative development fund, the blue is the cooperative education and training fund, and then the green is the like the dividends. So as you can see here, 1.5 million, 10% of it of 1.5 is 150K. Then 5% of 1.5 is 75%. I mean 75,000 pesos. And then 5% of 1.5 again is 75,000 pesos, and the 80% of the 1.5 is 1.2 million pesos. So basically, if you total this one, it's the same as this. Same goes here. If you follow the methodology earlier, the percentages 10%, 5%, and 80%. Then once you total this one, it's pretty much the same here. Okay? So from there, our statutory funds, such as those reserves and CDF funds, are cleanly sliced according to our compliance assumptions that are listed here. Okay, let me just erase this one so it will be clear to all of you. And okay, so now let's proceed. Since we are now done with the income statement, let's now proceed with cash flow. So as you can see here, this is our net surplus for distribution, and that's also the same amount that is carried over to our cash flow statement. So again, cash flow statement, this reveals whether the co-op's aggressive expansion plans will jeopardize its liquidity or not. So in our operating activities, we pull in our net surplus and factor in changes in loans, like loans receivables and current payables. So our operations generate like robust net cash climbing to a certain million peso that we are looking forward. So here, as you can see, for visual reference, the 1.5 here, the 2.175, and the 2.7 million pesos are carried over here. right? So again, these pro forma statements are somehow interconnected. The one that's being calculated in the first income statement, it's then used now in our cash flow statement. Okay? So now going here, so in here, um since we already have the net surplus from the operations, then there are changes in the business as the year or the months pass. So these are not fixed amounts, the ones that you're seeing highlighted in light green. So basically these are the real real happenings during that financial year. So for example, there are changes in loans receivable. That's why there's we deducted 500,000 pesos. There's a change in current payables. So it has increased to 300,000, same as in 2026 and 2027 here. So these are real happenings towards those years during those days or months, what happened on that a certain company or organization. And so is the net cash provided by operating activities. So what from 1.5, it's now down to 1.3 million, 1.475, and 2.16. And then again, we it doesn't also stop just by doing those loans receivables and payables. There are also at times that a company or an organization invested to physical assets like acquiring equipment, acquiring fixtures, furnitures, and such. So this is just an example. So um the company or the organization has purchased, this is an example, property, plant, and equipment. So we have deducted 800,000 pesos. We purchased something, and then in 2026, here, we have also paid something to get something. So after that one, so it's just the same because it's just carried down. There's nothing else to calculate. And we also have here the cash flows from financing activities, like did we increase our member share capital? Some is there an additional members to the co-op that has invested money into the cooperative? Are there repayments already being paid by those members? So these are the numbers as well. And again, those highlighted in green are not fixed numbers. They are the actual numbers that's happening during the financial period. So let me just clear out my markings here. And so we are now um calculating the numbers again. So as you can see here, um you just need to add or calculate those numbers to get these numbers. Okay? Let me pause for a while. Okay, let me resume. Sorry for the intermission number. So again, let's go back here with the um, computation. Okay. So once everything is com- computed here, then we have to um now we have to calculate the net increase in cash and cash equivalents. So the 1/8 here that you can see is actually adding the three totals from above. Let me just mark it up. here. Let me just highlight it instead. So once you sum up all those three, so for example, these numbers 1 3 less 800K plus 1 3 again. So it's 1.8 million. This one you add this 3, it's 1.675, and then you add this 3 again. Now it's 2.463750. And then you now integrate the cash at the beginning of the year. If you can recall the one that I mentioned in the key assumptions, then cash beginning of year is 700K. Just input here 700K. The cash beginning of year 2026, it's here. Where is it? Here. Here. It's, it's carried over. So just imagine the 700K is from here, from 2024. Just to give you like a um visual explanation how the numbers are being carried over. So cash at the end of year 2024, it's the cash beginning of 2025. The end of 25 is the beginning of the next year. The end is the beginning of the year. So you can see the pattern is just carried over. Okay? And then um let's see. And then not only that, this also provides you the amount or the cash at end of year, because when you add this two, it will total to the one below. And that's how you have those numbers for your cash flow. Okay. And so when you reconcile these three activities, you can actually see like a trajectory of your like cash health. So our balance builds from an initial 700K in 2025. It climbs up to around 4.17 million in 2026, and reaches as a resilient 6.3 in like end of 2027. So this proves that our expansion strategy is completely self-sustaining. So those operational activities that are done during those um financial year, as we have assumed, like for example investing more from our members, um getting those contracts from port contracts, so such as those activities. Let me erase this, and we can then now proceed to balance sheet. So again, as I mentioned earlier, the numbers or the results from the income statement was used as a number or a value into the cash flow statement, and then now the numbers or the values from the cash flow statements are now also carried over to our balance sheet. So let's look at this culmination of our model, the pro forma balance sheet. So this gives us the holistic view of UPU Coop's structural health. So our total assets our total asset base expands significantly from like 11 million in 2025 to 17.9 by end of 2027 in our example, okay? And as you can see here, as you may know as well, it is always a fact that assets is always equals to liabilities plus owner's equity. So it's always something like this. The 11K is always balanced when you add this two, or this one that you can see. Similar to this, when you add this two or this total and here. So again, this is the assets equals liabilities plus owners. Okay? Because again, it's not called a balance sheet if it's not balanced. And so, in our example here, we have carried over the cash at end of year. So as you can see, the 2.5, the 4.17, and the 6.63 are carried down. Let me just make an emphasis on this one. So again, the three pro forma statements are interconnected. Okay? So just think of it as if once you have changed something in the income statement, it will really have a domino effect into the rest of the pro forma statement. So our assumptions are very tied or relevant with each other. Okay? So in our example, again, the cash at end of year is carried over, called as cash and cash equivalents at 2.5 million, 4.17 at 2026, and 6.63 in 2027. And then we also have here loans receivables for members, 5 million, 6 million, and 6.8. So again, as mentioned earlier, they are not just what do you call this one, like assumed numbers. They are the real transactions that happened during the financial year. So let's just say, for example, in the loans receivable, there's a loan receivable in 2025 for 5 million pesos, and then in 2026 there's an additional of 1 million, so it's 5 plus 1 million, it's 6 million. And then in 2027, loans receivable additional of 800,000 pesos, so 6 million from here. Oops. So let's just say plus 1M, and then plus 800K there. That's just an assumption that that's what happened during that year, those times. So property, plant, and equipment, and 2025, that's the value of the equipment or the property that was purchased is 3.5 million. Then comes in 2026, another set of equipment was bought at 700K. So that's 3.5 plus 700K. That's the reason why we have 4.2 in 2026. And then at that time, we also purchased something around 300K. So that's the reason why there's 4.5 million. Then just add everything. That's what we call the total assets, these numbers. And then liabilities and equity. So current liabilities, these are the amounts that we owe. And then same assumption as earlier, there's something that we owed, we've added our utang. So let's say 300K, that's the reason why we have 2.3 million. Then we added another utang, it's 200K, so that's now 2.5 million. Same scenario and same samples here for long term borrowings. This is the total of our payables or our liabilities, and then the capital or the statutory reserves and funds that we have. Then again, once we have this, then we can see that it's balanced because 11, let me highlight. So once you add this two, it's this 11K. Once you add this two, it's 14.375. Once you add this two, it's equal to that one. And we can assume, not just assume, you are actually seeing the balance sheet as equal. Meaning our balance sheet is balanced. Don't worry, I'll make sure to provide you the interactive or live Excel sheet for this samples that I've provided, just so you can have a play around as to how this pro forma income statement, cash flow, and balance sheet are interconnected with each other, with the summary or assumptions that we have taken into account. So feel free to use, make a copy of your own of this pro formas interactive tool or sheet that I have prepared for you. Okay, so um tying it all together, um we can also say that there are limitations of this pro forma statement. So as we prepare to wrap up our analysis, we must address that the real world vulnerabilities of our pro forma modelings, though they are very highly valuable, they are not always perfect, they are not always flawless. So, the first vulnerability that I can share with you, or like a classic rule of data science, is the garbage in, garbage out. If your initial top line revenue forecast is wildly optimistic or disconnected from market realities, like you are just purely assuming that it will really grow as fast as how you would like it to happen, the entire subsequent pro forma statement becomes an operational illusion. Second is an over reliance on historical trends. So just relying for historical data, pegging future performance entirely to that past percentage relationships assumes that the future will behave exactly like what happened in the past. A sudden macroeconomic shock, an aggressive spike in inflation, or an abrupt regulatory shift can instantly break those historical percentages. So again, we should not rely alone to historical trends. We have to be realistic as to what's really currently happening. And finally, um, with these pro forma statements, they can create a false sense of security. So, a beautifully balanced pro forma sheet represents a possible future alone, possible, but not a guaranteed future. So, it is a roadmap based on assumptions, not an insurance policy against operational missteps. So, let's tie it all together so we can wrap it up with this discussion. So our key takeaway here is that for our discussion today, looking at financial management as a comprehensive navigation system, revenue forecasting determines our destination, where we are headed to. Budgeting provides our operational guardrails, and pro forma statements gives us the ultimate map. This is our guide. The pro forma statements will give us the guide of what our balance sheet, our income positions, our current money, our assets will look like once we arrive the destination. So by integrating these three pillars, again, the income statement, the cash flows, and the balance sheet, when integrating these three pillars, the management teams and specifically organizations like the UPU Cooperative, as our case study, can safely navigate economic risks and optimize statutory fund allocations and ensure that it is sustainable. The long term wealth creation for stakeholders are secured, and again, I think that's it pretty much for our discussion for today. So, again, thank you very much. And I am very open to any specific questions or any deeper analysis you'd like for us to explore on our model assumptions. Again, you can always message me. I'll also send you over the link of our interactive tool of those pro forma statements. Thank you so much, everyone.